trades at a very high free cash flow yield, and it on a enterprise value basis and even on a market cap basis. And so, or sorry, even on a enterprise value basis, but especially on a market cap basis. And it's just too cheap. And so, this one is a services company, and it did have some Middle East exposure, but it's actually lost some of its affected Middle East exposure even prior to the conflict, which has actually suppressed their price. So I think their stock probably would go up a lot independent of this current situation. And then with rigs and pressure pumping and various other oilfield services activity likely to respond to the extent that the current conflict continues, I'm really excited about companies like this one that have most, if not all, of their upside exposure in services in North America and other advantaged jurisdictions. This one trades at a huge discount to its book value, to its likely replacement cost, to their estimate of replacement cost, to my estimate of their replacement cost, and even potentially to their liquidation value based on recent transactions for similar equipment and similar operations. So I think it's really helpful to own services companies that are very equipment intensive at large discounts to replacement cost, particularly at low points in the cycle. I've done this a few times before over the course of my career, and it's actually one of the most consistent and most lucrative kinds of investments that I've done professionally and personally over the last 20 years. I really like this whole buy companies at a big discount to replacement cost, sell them when people start trading them based on earnings and when they trade way above the replacement cost. And this one is somewhat unique in that it's very rare to find companies that are both trading at a large discount to replacement cost and are generating a lot of free cash flow. So that combination is very powerful and I think offers a lot of upside leverage to the extent that we go into an upcycle, which to the extent that this situation in the Strait of Hormuz continues, we almost definitely will be. And then I think people don't really appreciate how powerful paying down debt can be for equity returns. And I think it's because the returns from it tend to be uneven over time. So some of the initial debt pay down sometimes just leads to a derating in a stock. Stock price may not move up much, but over time, it can be extremely powerful and nonlinear, where the first dollar of debt paid down might yield no improvement in market cap and just a smaller enterprise value. But the 500 millionth dollar of debt that pays down, that $1 might yield a $5 increase or $10 increase or $0 increase in the market cap, sort of depending on where the leverage is at and at what point the market starts to get excited. I've found that there tends to be sort of the most excitement around debt paydown when it transitions over to dividend payments, share repurchases, revenue growth, various other activities, acquisitions even. That's where I've found these companies get most rewarded for their debt paydown. But I like to own them as big chunks of the debt are getting paid down because it's somewhat hard to predict exactly when they're going to flip to returning capital. And I want to make sure to be there so that I can catch the upside, as well as in this case, catching the likely cyclical upside. There's really just this huge benefit for these cyclical services companies that are also generating a lot of EBITDA and a lot of free cash flow despite being at a low point in the cycle. Especially here where we've seen oil prices go up a lot and some of these stocks are not up much